Alright, so here we go. This is my target price for Netflix. This is what I think the stock should be worth. It's based on two different valuation methodologies. The first is a discounted earnings per share, and the second valuation methodology is a price to sales valuation methodology. So, what is my target price for Netflix? Keep watching to find out. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence. What's up everyone? My name's Robbie. This is Robbie and Manila, and today we're doing a stock analysis of Netflix. So as you probably already know, many stocks of course are getting crushed lately in the stock market, and Netflix is an exceptionally crushed. It's exceptionally being crushed. It's getting clobbered basically. Right now, if you go back to the peak, let's say, in about November of 2021, so just last year, and we see how far this thing has fallen, it looks like it is down approximately 71%. So with the stock down that much, of course, you would think that Netflix would be a buy. It's a fraction of what it cost just a few months ago, so now it's got to be cheap, right? That's what we're going to try to figure out in this video. We're going to do a discounted earnings per share. We're going to do a price to sales ratio valuation. We're going to do some technical analysis. I'm going to go through my Cat 5 score. Let's go ahead and get this thing started, and let's start with the price to sales ratio. Okay, not wasting any more time. Price to sales valuation. What do I have for this year, 2022? I have a $224 price target for the stock. This would equate to a 13% rate of return if this was to occur in 2022 by the end of the year, let's say. And then 2026's target price is $351, meaning that if you bought it, held it, it'd be equivalent of a 12% rate of return until that time period. You know, for me personally, a 12% rate of return over that time period, I think I'd be okay with it. So I think right now, if I was using just this methodology, I might be okay with buying the stock. But of course, I want to look at some other valuation methodologies as well. So what I do here is I say, because of what's been going on lately with Netflix, which we're going to talk about in a second, I am decelerating growth at a lower rate to try to be conservative here. So if I give it a 15% growth rate in sales in 2022 and I decelerate that, so 15%, 14, 13, 12, 11% rate of return by 2026, that leads me now to step 3, which is the price to sales multiple. So now I go back and I say, what were some of the price to sales multiples at the end of the different years? So in 2017, 7.34, and these are the different years, and the average of these is 8.2, and then 7.65 is the median of these, and right now it's way below its average and its median at a 3, basically 3.04. So I'm looking at these and I'm going to go with something more conservative because of what's been going on with subscribers, loss of subscribers with Netflix. So what does this mean? This means that I'm not going to go with like a 9. I'm not going to go with an 8 or a 7. I'm going to actually go with a 3, which is the current price to sales multiple, which is a very conservative price to sales multiple, I would assume. And then, so if we do that, then what I get is a $224 price target here, growing up until $371. These are the rates of return. Again, like I always do, I show you a pivot table here. Let's go to my Cat 5 score, and then after that, I'm just going to touch on what's been going on with Netflix's loss in subscribers. So this is my Cat 5 score. It's based on the different categories I like to see in stocks. I actually use a decile system, which I'll describe in a second, but what I do is I basically compare Netflix with its competitors within the industry that it operates, not the sector. So I like to be more specific with the stocks. So to put this into perspective, let's talk about the decile system I use. So what I did here was I said, okay, this is the 5-year growth of sales or revenue, and it's 27.50%. So what I do is I compare the different companies that I think are competitors of Netflix, which ended up being 36 different companies in a similar industry. And then I say, okay, what's going on in deciles? So I basically rank these. And so the highest or best sales growth over this time period was about 49%. So companies with like over 50% growth, they're going to be in the first decile. So if you go down here, we're looking at 27.50. So Netflix is actually in the second decile. So it's like right here, 32 to 19, right? So it's in the second decile of sales growth. So it's got one of the best sales growth numbers out of all the different deciles inside the industry that it operates, let's say. So what that means is it's got a very competitive sales growth, right? And so that's a very good thing. So the higher the decile, the better. So when you look at the PE ratio of Netflix, now it's a 3, so it's in the third decile, so that's good. That's 18.97. That is a score of a 5. That's the highest score you can get. So what I do is I say, okay, if you're in decile 1 to 4, you get a 5. If you're in decile 5 to 7, you get a 2. And if you're in decile 8 plus, you get 0 points. So these are the numbers. So we have the forward PE is a decile 3. That gets the best points. The price to sales ratio is decile 7. So it's actually a little higher than some of the other companies in the industry. We don't have cash flow to compare here. So we actually get a peer valuation score of a 60%. So it's okay, not too bad valuation-wise. Could be a bit better. But now let's take a look at the profitability. So this is industry-based profitability. So the gross margin is in decile 6 with a 46.30% gross margin. That is a half of a score, basically. So 2 points. And then the net margin is actually in the best decile. So decile 1 at 20.40. So it has a very good net margin. It gets a full score here. It gets a 70 for the pure profitability score. I like to see 70s or more in these different scores, so I'm happy with that. For industry-based growth, we kind of went over this before, so we have revenue in the second decile at 27.50, gets a best score you can get, a 5. Earnings per share, actually in the first decile, with 90.50% growth, that gets the best score. And then we have a free cash flow. We don't have that in this one, so that gets 0. This has a pure growth of 67%, so close to that 70% mark I like to see. Then we have liquidity. I just take a look at the debt to equity ratio. Pretty simple here. This is actually industry average of 1.67, so actually pretty high. And then this only has a 0.83, so that passes. That gets the best score possible. It's a 100% liquidity score. And this brings us down to the last one, which is what I call the Rolex score, which is what I like to see. It's like the quality and the trust of the company. I use a Piotrowski F score here. I like to see it as a 7, 8, or 9. This gets a 6, so this actually is going to get 2 points for Piotrowski F score. Shares outstanding, I like to see them decreasing in a situation like this. They're actually increasing, so I'm actually going to give them 0 points for that because I don't like that they're increasing their shares, diluting us a bit. So for the Rolex score, it's actually going to be only a 20%, so not a very good Rolex score. When I add all these up, we come to a total Cat 5 score, 36 points total possible. Is 60, and then we have a total score of 60%. So I like to see it around 70%. This is under it, so there's some categories that don't look as good as I would like, but the score isn't that bad. Now before I move on to the discounted earnings per share, I do want to kind of talk quickly about what's been going on with Netflix. Now, they've lost subscribers recently. It's the first time in years that this has happened. They've actually lost about 2 million subscribers. Now, this has been, a big concern about what's going on with the company because this company has really been, it's a growth stock, right? So the more subscribers it gains, the better the outlooks, the higher the multiples that this company was going to be trading at. And now suddenly, as subscriber growth is not growing like it was, basically the market's questioning, does this company actually have the ability to still increase, let's say, free cash flow, for example, if it can't even get there right now, and it has 200-something million subscribers. So at 221 million subscribers for Netflix, I have revenue of 29 billion, almost 30 billion. So I divide this, and I say, okay, that's $134 per subscriber. And then I come down here and I say, okay, what if we increase the price of the subscription over time? So now if we have these two things happen, they increase their prices and their subscription, the people who are subscribed basically increases 5%. We have 32 billion in revenue. That's a 9.7% increase. Here, this 35 again would be a 9.5% increase. So as you can see, if they both increase their price and they increase the amount of subscribers they have, the revenue grows fine. But now I want to see what happens if, let's say, the subscriber count doesn't grow, but they still increase their prices a bit each year. Netflix is losing subscribers, and what do we have if that happens? Well, as you'll see, because they're still increasing the subscription cost, it goes from 29.6 billion up to 30.4 billion. That's a 2.39% increase in revenue. Then 31 billion goes to 2.2%, right? So basically, if they don't grow their subscriber base, but they did just kind of, let's say, milk what they have, and the people that still have the platform don't leave the platform, then they can still grow a bit even if they just like increase the amount that they're charging every year. Now, of course, there comes into the question of like how much they spend on creating content, and they need to continue funding that. And so, there's just basically a delicate probably balance that Netflix is trying to navigate essentially. And there is this weird thing that's going on with their earnings, let's say. And as you saw, the earnings were growing at like really high rates before, but there is an issue with that. So as you can see here, this is a cash flow statement. And of course, you want companies that have great cash flows, because cash flows are technically the discounted cash flows of a company are what a company should be worth. So when you take a look here and you see cash flows from operations, you see the net cash provided by operating activities here is actually declining. It was finally some free cash flow, which they didn't have for a long time last year, 2020. Then it reduced in 2021. Now, the reason this really happened is because in 2021, there was a pandemic and things were shut down. They couldn't film. And so essentially, they spent a lot less creating content. And so that ends up coming in here when it says additions to content assets, and you see how much larger this is, 17 billion versus 11 billion the year before. So we had a giant jump from one year to the next in how much they're spending on content. So we come over here to the consolidated statements of operations, and we see at the top here, 2021, we have revenues, 29 billion. And then we see this thing, which is cost of revenues. And this is like a very important part. And it's kind of weird how Netflix does this. So what they do is they take all of their the money that they spend to, let's say, produce their content. So let's say they make 100 different movies and shows and things like that. And it turns out into this giant number, multiple billions of dollars. What they do is they basically say, like, over a few year period, we're going to be paid back for these things we're creating. It's not all going to be in the first year, right? Because licensing and all sorts of reasons why, let's say, for example, Bridgerton, which is a popular show. So Bridgerton, over the next few years, may make extra, additional money, not in the year that the episode comes out, but, a few seasons later, the first season's probably still making some money, right? So they're putting this money in, and they're basically amortizing the money over a multiple year period. And so this number is kind of not exactly what is reflective of what's going on in this year, right? So this is, let's say, we're actually going to call this understated. And so that means that I think that the fact that the earnings per share are growing so much has to do with their amortization here. Another reason I'm not using EV to EBITDA on this one is because of that huge amortization they're using, which that A in EV to EBITDA is amortization. So that's why we're not using that. Anyway, long story short, I don't think that Netflix is going to grow its earnings because of how much they do have to spend on content creation, and how that kind of delays how much this cost of revenue ends up being, and then how this kind of helps them look like they're making more money than they are on their income statement. So let's go to the earnings per share and take a look at that. So I'm over here on GuruFocus.com, and basically what you're going to see is Netflix has crushed their earnings per share growth over the past 10 years, 53.90% growth. It's incredible growth. Over the past 5 years, 84.8% growth in earnings. Over the past 1 year, 33% growth in earnings. So what I'm saying is, I don't necessarily think that this is going to be able to continue the way that they book that amortization on their income statement. I think eventually this is going to all catch up with them, right? So I'm essentially going to use a much lower growth rate because that's what I think is happening here. And so I'm essentially trying to be conservative in this. And so I'm going to say, instead of 33% growth in earnings, 84% growth in earnings, I'm just giving them 10% growth in their earnings. Remember, they're also losing some subscribers potentially, and growth can be really hindered, and I don't know what's going to happen with the future of this company. So I'm using only a 10% growth rate in earnings, and this gives me a price target of $210, and that's essentially a fair valued stock using this type of valuation methodology. So for my actual price target for the stock, what I have is a $217 price target, which I do think is using pretty conservative assumptions for Netflix, which is going to be an upside of about 9.38%. This is for this year right now, so 2022, this would be the price target now. And then I used a 50% weighting for the earnings per share, discounted earnings per share, which was a $210 price target. And then the other half of this is $224 price target I got with price to sales valuation. That's how I got this number. So, okay, that's my number. There's a bit of an upside here, not as much as I'd like to see, but let's take a look at some technicals because this thing is it's nuts. This is Netflix. This is a pretty long-term chart for the company. It's going back to 2017. As you can see, back here, starting in, let's say, June of 2018, where I have the top of this uptrend channel starting, and growing all the way up, multiple points of touching that parallel line of the uptrend channel. And then we get up here and it breaks up through the channel, and then it hits a high of about, let's say $700 area, and then it just gets absolutely pummeled. Within about 2 months, it went from trading up outside of this uptrend channel to breaking down through the bottom of the channel, and it's basically inside, or was inside, of a really, really steep downtrend channel. Let's zoom in a bit to see some more details here. Some things I wanted to show you are just how big some of the gap downs this thing has had. So here where earnings were released back in January of 2022, a giant gap down, and then it traded, let's say, consolidated a bit over this time period. But then that's when this next part is where it did gap down again, and this is where we are today. And this thing is just sitting down here after another giant gap. And just close to $200 per share. So maybe the price ends up consolidating here. I don't know if it's going to use this line as support or resistance. We'll see what happens, but I do think that right now I am waiting to buy the stock if I'm interested in it. Some good things about it, though, are that it is oversold according to RSI, which is sitting around the 15 area, 18 area. So that's definitely in the oversold territory. And so even if this stock does, get a bounce here, we're going to have this moving average potentially acting as some resistance. We'll see about that. That may or may not happen. It looked like it did kind of happen in this area. And so for me personally, I don't think Netflix is going to give me a high enough rate of return right now at this level to enter the position. So what I would do is I would say if it goes down further and then I have a target price that I think is going to give me a bit higher of a return because let's say the price goes down to, let's say $150 a share, that might be a good point for me to enter this position in my opinion. But I would want to watch it and see if it consolidates, and then once it does, I would want to maybe enter a position as long as it's getting close to my target price there. So anyway, that's all I have for this video. Please, if you liked it, hit that like button, subscribe to see future videos like this. And support me. I got some affiliate links down in the description below. Take a look at those, and I have another video coming up on the end screen right now.